And hello, everyone that I guess, talking to. This is just going to be a quick rant on something that has come up a lot in conversation with me throughout, I don't know, years, actually. I think it's been years. Because I've been studying Forex. I can't say trading officially because I've only actually traded real money a select amount of times, and it was a small portion of money. I've been studying Forex and trading practice accounts for a few years, and during that time, I have had some interesting conversations with a lot of people. When I bring up the concept of Forex or foreign exchange, a lot of people that I talk to seem to have already heard about it, and their opinion seems to be that Forex is gambling. And when they say that, I usually want them to elaborate a little bit more. When they say that, they specify that Forex never makes anyone money and it's always gambling. And those who actually allegedly make money from it are doing it from, say, like scamming people through educational material about Forex, or they just got lucky. Maybe that could be the case. I've had some people say that to me. I want to sort of explain what I've learned about Forex and how it's not as simple as people think. Forex, I will say this, Forex can be gambling, but no, in its essence, it is not gambling, because gambling is literally rolling the dice, or rolling the dice of chance and seeing what comes out the other end. In Forex's case, there are patterns involved, and Forex is not the way I trade Forex is purely based on patterns. Now, there are a lot of people that trade based on the news, and then there are some that trade both the news and patterns. I trade purely on patterns. I don't care what the news has to say about the economics because the price always repeats itself regardless of how high or low it goes. All right, so I'm going to explain as best as I can how Forex isn't isn't gambling, um, in at least not in the way that I'm trading it or that other professional traders do trade currency. You can easily go into Forex, throw in $10,000 into a brokerage account, and just start trading without knowing anything about Forex. And that, I would say, is gambling. You're just gambling your money away because you have no idea what you're doing. And there you go. That is gambling. Now, I hope that after explaining this, some people will understand better what I mean when I say that Forex is not gambling. Because when I've had these conversations, I can't exactly show them with images or explanations. It usually falls on deaf ears, or they just think that I'm trying to overcomplicate it and be fancy to try to confuse them or something. I'm not. I'm simply trying to explain to people that don't understand that there is simply something about this that they don't understand. Now, so my first example is, I'm going to focus a lot of this on what's called confluence. So confluence is a series of different techniques that that show you, or that confirm with you, that price is going one way or another. Now, nothing in Forex is 100%, but confluence helps you to sort of minimize the risk, in a sense, of which direction you're choosing to go with your trade. So, one example of confluence would be, say, these EMA, exponential moving averages, that I have. The green, blue, and red lines that I have here, they are sort of a moving organic average of what price is doing. Okay. Um, I don't normally use these on the daily chart, but I normally use them on the 5 minute chart because the 5 minute is, or the 10 minute. Actually, on TradingView, I don't have a 10 minute, but on this practice account, actually, I'm not sure if I have a 10 minute here either. No, it's 15. I'm sorry. I have a 15 minute here, and I will often use exponential moving averages on my 15 minute charts. And that's a totally different strategy that I use sort of on the back, sort of whenever I see something in the 15 minute that looks like a really good opportunity, then I'll take it. Now, so for this, I can actually remove these so that it may. So I'd rather remove these so it doesn't confuse people. It'd just be easier to delete it. Okay, so now we just have a blank chart. I'd actually like to take the grid away. Let's see. Haven't done this in a minute. I've changed things a lot. Vertical grid lines. Let's see. Yeah, they've updated a few things since the last time I was using TradingView, and I can't exactly remember how to remove the grid. That's okay. The grid is fine. So the grid can be very helpful. Usually, actually, I usually never remove the grid while I'm actually trading because the grids are lined up exactly. You see where my cursor is? It's at the 1.6500 handle. Okay, now and the next one at the well, you can see it. I did it perfectly a second ago here. You know what I mean. So we got the next one at this 1.6700 handle, 1.6600 handle, and so forth. Those are important numbers because a lot of people tend to have a lot of sentiment towards round numbers. They just mean something to a lot of traders, and so you'll see a lot of activity around those numbers. Okay, now let me try to explain this as best as I can. So in the market, I'm going to have to explain this to whoever is watching. Hopefully you are someone who does not know hardly anything, if anything at all, about Forex. All you know is it's kind of like stock trading, which I hate when people compare the two because it's a different world than stock trading. Stock trading you can trade stock on patterns, but it's not nearly as predictable as Forex when it comes to pattern trading, or price action trading is a more official term for it. Stock trading is very heavily influenced by economic news, any sort of news based on around the specific stock you're trading, or even other stocks, or what's going on in governments and so on. But see, okay, so what we have here is, of course, I'm sorry, I don't have the pro version. I used to have it. I don't care about it anymore. So we've got price. This is where price was. Okay, this is how the market moves. It moves up and down. That's all it does. And these candles represent that. These are Japanese candlesticks. That's what they're called in the Forex and as well as the stock market. So these candles, the base of the candle, you see, let me actually zoom in a little bit more, sort of get a bigger candle here. You see this big white candle here. I changed the colors myself. Normally they're green and blue, green and red. Red for bearish candles, and green for bullish candles. And bearish means price goes lower, and then bullish means price goes higher. So the base of this candle, right from here all the way down to here, is where price started. The starting price of this candle on this day, because it's the daily, on the 2nd of April 2019. I'm sorry, over here. Price started here at 1.6. I'm sorry, I'm going to move around and being spazzy. 1.63113. Okay, that's the day started on New York time midnight at that price, And then over time, it sort of went down, as well as all the way up here to the highest high of this candle, which was right about here at the 1.6022 price, and then came back down before settling right here on this price, 1.65447. Okay, that's essentially what these prices are doing. That's what these candles represent. With the wick, this is called the wick, and this is the actual base of the candle. And the colors are to help represent which starting point and ending point they were. All right, and so here we have something that's an uptrend, and you can mark that like so. And so if you were trading at this point in time and you saw that this was an uptrend, you would be more inclined to buy than to sell as price went up. And then as price broke that trend, you become more inclined to sell. And you find your trigger, and then either price goes up and it breaks your trigger, or price goes down and confirms what you were suspicious of. That's a weird way to say it. But anyway, let me go to a smaller time frame. We'll go to the 1 hour, and holy cow, we'll just flatten them all like pancakes. I like this. This is a really nice downtrend that the Euro New Zealand had. I think that one example would be good to sort of solidify that this is based on confluence and repeatability instead of just guessing, because there is no guessing involved in this. Or, well, there's a slight bit of guessing, but I mean, it's an educated guess. Okay, it's based on your education of where the market normally goes in certain circumstances. Okay, so we have a very strong downtrend right here, right? Okay, so this downtrend on the hourly, let's give an example. Like, let me see. Okay, it's going to have to be, I need to find my specific trigger candle. Okay. Now, I know this would probably make a channel as well. I trade channels, and this is a channel. So it's a bearish channel, okay? And a channel is where price bounces from support all the way up to resistance over and over again. And every time it reaches a certain point to one of either support or resistance based on which way you're trading. In this case, it would, if it reaches resistance, you look for, or I look for my specific trading candle. All right, so I'm going to zoom in and I'm going to pretend like I'm actually trading. Okay, so we'll pretend like this is actually where the market is right now, and I'm just going to move piece by piece. Will it let me? Yes. Okay, so I'm watching price. It broke below the support level, but then it quickly came back up, and I suspect that and I know that this is something we just saw, and so it's already, the future's already, I already saw it, right? But this is how every trade goes. This is it, and it either works or it fails. And then I'm going to show you something else. So we right now it seems like a 50-50. It either works, either the trade goes through and it hits my take profit, or it fails and hits my stop loss. Okay. All right. So we've got this sort of an indecision candle. Then we have another indecision candle with a spike on the wick right here. So it spiked up, but then it was like, I don't think so, right? So it's like, so it freaked out a bit right there. So we have some indecision in the market, right? So we have 3 candles in a row where people are in the market are thinking, I'm not sure where we want the price to go right now. Then the price goes lower. So they're thinking maybe we should go back down to support. And then buyers are saying, no, we're still sticking to this area. This price is looking pretty good. Then the buyers came in and spiked it a little bit more and said, it looks like we are going to reach this resistance level, and that's what it's looking like. And sellers, of course, are having a hard time with that. Buyers come in again and are just making their punches, and then we have this. So it has reached the resistance level, but I trade these candles right here. I know sorry. This candle right here, this tiny little, it looks like an upside down cross, but it can have a base that's a little bit thicker than that, or it can be just like that. That is this right here is actually like a textbook indecision candle. But I like to call them a pin bar. In this case, a bearish pin bar. So this pin bar, basically what it was price opened on this hour, because we're on the hourly, and it spiked up, the buyers pushed, and the sellers pushed behind, but stopped short of going lower than that price. So we have an indecision candle. Okay, now I'm going to go back. Now if I were to go right here, well, it looks like when I weigh it, kind of, all right, regardless. Okay, so right here, once price, okay, I should actually go to the next one. Okay, we'll pretend that's not that big. We'll say price went right here. Okay, when price goes right there, what I'm going to do is sell. As soon as that happens, and I'm going to look at the price. Oh, well, they changed that too. Nice. It used to be a floating box. Anyway, the price that I would be selling at is 1.627. Well, let's look at that again. I'm sorry, 1.67273. We'll just do 72. Yeah, sure, that works. And the quantity, of course, I have, if I have a large, I'll say 10,000 units. My take profit, I do want to be specific where my take profit is. My take profit would be, I would say, okay, so since it's right here, I think my take profit is actually going to be right here, but we'll say at this handle because it's a good, nice number. And so a little bit, we're going to risk a little bit less, just because this number would be a pretty safe number to go. So 1.66800. 1.66800. All right. All right, that's a profit of 47 pips at the price of 1.66800. The amount of money, $31.97, is the reward. The risk, which is my stop loss over here, will be up above. So it'll be actually at this handle, 1 point. So if price comes up and I go into the negative up to this point, we can safely assume that my trade has gone bunk, right? Okay, so we're going to put my, limit, stop. Yeah, okay. So then I'm going to make my stop loss at 1.67400. That is a risk of $8.59, a percentage of 0.17. Well, okay. The percentage is based on the actual money that you have in your, so basically your equity. So the amount of money that you have in your brokerage account. So I'm only risking 0.17% in this stop loss. That is really low and a really good percentage. And the difference between 0.17 and 0.65 is that the reward, actually you could just look at it in cash wise to make it easier for you, is that this is 31. Okay, so 31, it's essentially $23 apart. So a $23 difference. You have $8 you're risking, $31 that you would be making if the trade goes well. So you're risking far less than you're making, than your potential to make. What this means, oh, and actually, just before we start, actually, I wonder if I actually make this, if it will actually go. Okay, so doesn't quite have, okay, let's go. Boom. Right, and it placed it, okay. So it did exactly as I was saying, and then I'll just move along and see if price, okay. So price did actually, and I actually forgot if it did or not. I actually thought maybe it spiked a little bit, but it did not. So in this case, I would have won the trade. It would actually be better if I lost the trade, so I can give you an example. But in this case, I won the trade. It pulled me out of the trade, which it didn't actually. I just need to cancel this. So anyway, um, in this case, I won the trade and I profited $31.77. Okay, if I had lost, then I would have only lost $8.11. Right? So say I make another trade and I lose again, but it's with the same circumstances, same amount of risk, and the same circumstances come up like this. Say the trade triggers and so on. Say I lose again. Okay, a second time in a row, I've lost. That is so far it's pretty bad. It sounds pretty bad. Well, I've only lost $16.22 essentially, if it was all just exactly the same. And if I trade a third time and actually make the money and actually make a good trade, then I've actually made up that loss and profited even more. Okay, so that is sort of essentially how I trade, right? So doing this, I've turned several accounts. Now this one's just a practice account, but I have turned practice accounts into very large accounts. I did this years ago, and I have not been doing what I should be doing because I've been a little discouraged from not being able to catch up on finances and just life happening. But I have turned about $1,000 account into I would say $50,000-$60,000 in a practice account in a couple of years. So just over maybe a year and a half or a couple of years, something like that. And I used the same method over and over and over and over again. The reason I think that a lot of people say that trading is gambling is because you have a lot. Well, first off, 93% of traders, I believe that's still the statistic, 93% of Forex traders lose all their money. They lose all of it. But I think the reason that statistic is the way it is because most people that lose money when they start trading, they just stop. They just give up. They don't trade anymore. They say this is just a scam, and then they go away and they tell other people that Forex is a scam or it's gambling. The thing is, you have to treat Forex like it's a business. Every time you're trading, you have to treat it like it's another day at the office, right? Lose or win, bad day or good day, it's another day at the office. You have to treat it like it's a business. You're going to lose, you're going to win sometimes, you're going to have bad days, you're going to have good days, you're going to have bad months. The point about trading Forex is that over a longer span of time, over by the end of the year, say, you end up profitable. If by the end of the year you don't end up profitable, there could be a number of reasons why that is. Maybe you're over leveraging. Maybe your strategy is using too high of a risk to reward ratio. So your ratio that I was showing you here, maybe you're risking way more than this and way more than this percentage of your equity or your capital. You're risking far more than that and not giving enough space for reward to sort of make up for the losses. Instead, you're saying, well, I'm going to let the market sort of stretch to the negative a little bit so that I can, because I think the market is eventually going to go my way. And then you're letting the trade sort of go bad even more so than it should have. So it's really complicated. There's a lot of different reasons why people end up not profiting from Forex. But I hope that this kind of maybe explains and helps people understand that Forex is not gambling if you do it right. If you are treating it the way it should be, and you're not using your emotions to trade, and you're treating it like it's a business, like I said. Um, so I think that's pretty much the only way, and that looks kind of silly on the daily. I'm going to delete those. Anyway, so I think that's pretty much all I can say for now. If there's any questions, if anybody even watches this at all, don't hesitate to ask me. I always love answering Forex questions. I love talking about this stuff. I'll talk about it all day if you want me to. Anyways, and also if you need to know more about my strategy, then you can ask me. But I don't recommend it because whenever you're trading Forex, you need to have your own strategy. You need to develop your own strategy, something that's comfortable and works well for you. Um, and then a lot of people are probably not going to be that interested in Forex, at least not people that I know. But yeah, but at least, okay, just last thing before I go. The next time someone asks me, or tells me, rather, that Forex is gambling, I'm going to refer them to this video. And if this doesn't help answer the question, then hopefully I can do that myself. Okay, I'm just bumbling at this point. I hope everyone that watched this benefited from it. If not, I am sorry about that. You probably clicked on the wrong thing. And so, yeah, cool. Have a good one. Everybody enjoy the day and the rest of your life.